Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We're going to be coming to you live from the 85th Annual STA Market Structure Conference in the nation's capital of Washington, D.C. Joining me for this segment is Dave Weisberger. He's the CEO and co-founder of CoinRoutes. Dave, when I think of market structure, I think of you. Traditional, non-traditional assets, everything. This week, though, you have a bone to pick with the buy side. What's going on?
Well, I wrote an article about this. There was a case where Citigroup mistakenly told investors that they were interacting with retail trading and got investors to pay more commission to their dark pool than others because they were interacting with retail, which is theoretically more valuable. Except this went on for 4 years. And during that 4 years, and by the way, there's no excuse to Citi for doing what they did.
Right.
I'm glad they were fined. It was after I left is when it happened. But the reality is, how could investors for 4 years not have known that this was going on? If you were measuring, then you would have known that you were paying excess commission and it wasn't worthwhile.
Right.
Now the reason for this is because the buy-side traders inside investment managers are very often marginalized by the portfolio managers and management. They're treated as a cost center. So the traders aren't given the budget to do what I would call analysis of total cost of trading. So,
because they're only doing TCA.
They only do transaction cost analysis.
Right.
They only look at the orders they do fill and not what happens when they don't get things filled. So by sitting and waiting in Citi's pool, did it cost them money? Did it make them money? They don't have any idea because they've never even looked at it. And that's the point that I was trying to make. I want to be clear. I don't blame the trading functions, although in some cases it probably is their fault. I absolutely blame the management of the buy side for devaluing trading. And that's a really critical point, because if you don't understand what it costs to trade, you can't possibly create the appropriate or optimal portfolios. You can't possibly manage and get all your returns.
Right.
And yet that's what goes on in the traditional buy side.
So is it only equities, or can you apply this to crypto assets?
Well, it applies extremely well to crypto.
Right.
The fact is I think because there isn't this idea of a star system portfolio manager, you have this notion, people kind of understand they need to control their costs. Now, crypto and equities are different.
Right.
Equities, explicit costs are a small fraction of what you pay in your overall execution. You're more worried about market impact and bid-offer spread. In cryptos, bid-offer spreads are microscopic, but explicit costs are actually relatively high, and market impact is off the charts.
Mm-hmm.
And so you have to look at those things differently, but understanding total cost of trading is vital for the performance of whether it's a crypto fund, an equity fund, a bond fund, it doesn't matter.
Right.
Yet, a lot of funds don't look at that.
Do you think the buy side's going to pick up on this?
I hope so. I've always hoped so.
What's the downside?
The downside is that compensation for the star portfolio managers has always been off the charts, and they still run buy sides. Buy sides are run by marketing and portfolio managers. What you need is firms, the newer firms that have achieved much better returns, like my ex-firm, 2 Sigma, where their 5th employee did execution research. And they have always considered execution a key part of the triad of what they need, with 3 legs being trading, portfolio management, and asset price prediction. People think of 2 Sigma as, well, they're smarter because they do a better job of predicting prices and they look at more data. And maybe that's true, but I guarantee you they invest equal amounts of resources in the other legs of that chair, and by doing so, they can sustain their returns.
What are some of the key themes that you're picking up from STA 2018?
I think it's funny for me. So I came down here more or less as a vacation because so many people down here are my friends. It's a great opportunity for me. And I watched Chris Concannon talking. He was talking about crypto as all people walking around with man buns. Now I know if I put a man bun, and I do have the hair for it, but if I created a man bun, my wife would be, no, not a look.
Yeah, I don't think I'd let you back on the show.
My son, who's a 25-year-old, he's not wearing a man bun either. But the reality is that crypto has been mentioned in almost every single speaker that I've seen, except for Ben Sass, who was interesting, but he didn't talk about financial markets at all. So to me, it's fascinating to see more and more of my colleagues become interested in a space that I believe will be transformational for capital markets, which is why CoinRoutes is out and we're raising money and we're signing up clients at a rapid rate. But we're still in the early stages. I think crypto is like in 1993 for the internet. So we had a long way to go. But a lot of the issues that equities are dealing with are ones that crypto has to deal with. Equities dealt with them in the 90s. And we're dealing with them now.
Right, but that's one thing that you and I always talk about. It's not a one-size-fits-all model. You can plug and play crypto into mature markets like fixed income, like equities. It's just not going to work.
No, it's different. Look, crypto is different than equities in a couple of very key ways. The bid-offer spreads are microscopic compared to fees. That is a huge difference. The liquidity is very different.
Right.
Equities liquidity is concentrated all within the top 10 or 20 levels of prices where 90% of all liquidity is. In crypto, you have to go over 1,000. We actually cover 4,000 price levels to get to most of the liquidity in crypto. And it's because of the retail nature of the product. So there's vast differences. There is still much work to be done in settlement. I mean, Chris was very eloquent about this in his speech. He's right. The fact is there is many reasons why a fine-tuned market structure can make progress. Let's face it, our equity markets are the best in the world. It's one of the most liquid, fairest markets out there. Is it perfect? No.
Right.
But it's a model that you can learn from. Crypto is nowhere near that yet. That's one of the reasons that I jumped there, because there's more rewarding work to be done there, where we can actually make more improvement.
Well, thank you very much for joining us at STA, and thank you for joining me throughout the day. I'm Jill Malandrino, Global Marketing